infrastructure is known as a defensive asset class with lower volatility of earnings and a higher yield relative to general equities. It's known as a defensive asset class because of quite unique investment characteristics, which do all work together to provide you with that long-term, visible and resilient earnings stream. Now, what are those characteristics? Well, when we screen our very broad universe of infrastructure-like stocks to get to our core investable universe, we're looking for things like monopolistic market positions or ones with high barriers to entry. We're looking for earnings that are underpinned by contract or regulation. We want really high upfront capital costs, but then very low maintenance spend and a largely fixed operating cost base. And we want an inflation hedge. So all of these characteristics come together to provide that visibility in your earnings stream and that defensiveness that investors want. Now, for us at 4D, having screened a very broad universe of stock, that gives us a core investable universe of about 300 stocks, which is into two very broad subsectors. One being what we call essential services, which are your regulated utilities in the gas, water and power space, and the other being what we call user pay assets, which are your toll roads, your airports, your ports, your rail operators and sort of communications infrastructure. So that's how we define infrastructure. It's really about a case-by-case assessment of the assets to give us those defensive characteristics. Our view is that infrastructure has a place in all balanced portfolios. What it adds to a portfolio or how it should be positioned within an individual's portfolio really depends on the starting point of that portfolio. So infrastructure could be used to add liquidity to an otherwise infrastructure allocation. It could be used to add equities, so that first move into equities for a very defensive bond portfolio. It could be looked to add or de-risk the equity component of a portfolio. You could add some global exposure to a domestic portfolio or even just a yield to a portfolio. So infrastructure has a number of places. It is that defensive asset class and relative to other defensive asset class. It has a real ability to actively position for the economic cycle as well. So it gives you defensiveness, it gives you actively managed ability, and also gives you a huge growth pipeline because there's so much infrastructure investment needed in the world. So for us, it has a place in all balanced portfolios, and importantly, I think what we're seeing is there's an increasing recognition of that because the asset class is being considered its own now. So we're seeing people really see that as a real asset class. A great way to think about it is the shift of the portfolio that we've had from 2020 to today. Look, used to pay assets, COVID was an unprecedented event. It was short, hard and really painful as of March 2020, and it really hit earnings hard for those user pay assets. Flights were grounded, no cars on the road. That was a real earnings impact and it required a real valuation shift. So we definitely saw user pay suffer as a result of those closed downs and lockdowns and quarantines. And by contrast, the utilities really held up very well because their returns don't rely on volumes, don't rely on people on the roads. So in that point of view, we can actively move between those two subsets. So in 2020, when all this kicked off and we really saw economic upheaval over the next few months, we went overweight or increased our exposure to utilities, really trying to weather that storm of the economic shutdown. Saying that, we didn't sell out of what we considered to be very oversold airports. We thought that the value correction or the equity market correction was totally disproportionate to the value correction. So we did maintain some really oversold user pay assets. But since then, and since we've seen the vaccines come out, we're starting to see economies start to reopen. There's huge pent-up consumption demand out there. We're seeing huge amounts of stimulus flow through into the economy, and we're seeing inflation come back. For us, that means it's really supportive of that user pay exposure. So we are now overweight user pays. Really prepared or positioned for not only the return of travel, consumption, stimulus, but also the return of inflation. Huge buying opportunity, and I think airports is probably the best example of that. When we saw the March correction, they sold off by 35, 40, 50%. Now, yes, the earnings impact on those airports in the 2020, 21, and even now 2022 is harsh, really harsh, and it does warrant a valuation adjustment. However, you've got to keep in mind these assets are 50, 60, 70-year assets. So there was nothing structurally broken about the airport thematic. So yes, while there was a valuation correction needed, it was completely overdone. So for us, keeping in mind that we don't believe that there's a structural shift in airports, we saw that it's a real buying opportunity, and we're starting to really see that traffic come back. We're seeing it come back faster than people anticipated. We saw the airports react really well to the situation they were in, and they should emerge stronger and in a better position as a result of this phenomenon.